Hey everyone, and welcome. Today we're taking a deep dive into what's really driving the record prices we're seeing for gold and silver. Seriously, we're seeing some major stress signals in the system, things that haven't popped up in decades. So what's actually happening behind all the numbers? Let's get into it.
And we're kicking things off with this quote from analyst Jim Rickards, because honestly, it just cuts right to the chase. The analysis we're looking at suggests that the moves in precious metals right now aren't just your typical market ups and downs. No, this could be about a fundamental shift in the entire global financial system.
So, to really get our heads around this, here's how we're going to break it down. First, we'll look at the big picture stuff, the system under stress. Then we'll get into this wild disconnect between paper prices and physical metal. After that, we'll focus on the unique supply and demand collision happening with silver. And finally, we'll look at what all this might mean for the future.
All right, let's jump right into our first section. Before we can really understand the story with silver, we have to look at gold. We need to get the big picture on these massive global currents that are pushing not just investors, but entire nations back towards gold. The analysis we're digging into points to four huge drivers pushing gold higher. And it's not just about the Fed cutting rates, which is what you always hear about. These are much deeper structural shifts. We're talking about massive, consistent buying from central banks, a classic supply and demand crunch, big money institutions finally dipping their toes in, and the growing use of the dollar as a weapon on the world stage. Let's just focus on that first point for a second. Ever since 2010, central banks around the world have completely flipped the script. They went from being net sellers of gold to net buyers. Think about that. This creates an incredibly powerful floor under the price. They're not just chasing high prices, they're strategically accumulating, often buying when the price dips. So for you, the investor, that means you have some of the planet's largest financial players basically putting a safety net under the market.
Okay, and this right here is the real heart of the story. Because while gold is showing stress on that macro level, the silver market is where the cracks are really starting to show. And they're becoming impossible to ignore. There is a massive disconnect opening up between the price of a paper promise and the price of actual physical metal that you can hold in your hand.
To get this, you have to know there are two main places setting the price. Over here in the West, you've got the COMEX. Think of it as the paper price. It's all about financial contracts, and almost nobody, we're talking less than 3%, ever takes delivery of the actual metal. But then you have Shanghai in the East. That is a whole different ballgame. It's a physical market where giant industrial companies go when they need real silver bars to build things. So let's look at the COMEX, the paper market. The price on the screen is hovering around $79 an ounce. And for decades, that was the price everyone looked at. But what about Shanghai? The place where factories actually need to get their hands on the stuff to build solar panels and EVs? Well, over there, they're paying $85. That was a huge gap. Now, the way our sources see it, this isn't just some regional premium or a shipping issue. No way. It's a distress signal. It's the market screaming that the price you see on the screen isn't real if you actually need large amounts of metal. The physical supply is tight, and real buyers are willing to pay way more to get it.
So this begs a really important question, right? In any normal market, traders would be all over this. They'd buy the cheap paper silver in the West, demand delivery, ship it to the East, and sell it for a quick, easy profit. That process, arbitrage, would close the gap. So why isn't it happening? Well, the answer our sources give is as simple as it is shocking. The physical metal just isn't there in the Western vaults to make it happen.
And that leads us right into our third section. Because the answer to why that price gap isn't closing lies in silver's incredibly unique and, frankly, precarious position. It's caught in the middle of a massive collision between exploding demand and an incredibly rigid supply. You see, the demand for silver today, it's not your grandparents' silver market anymore. It's not just about coins and jewelry. Our entire modern world, our green tech, our digital infrastructure is literally built with this stuff. Solar panels alone are just gobbling up a quarter of the entire annual supply. And you can add EVs, 5G towers, AI data centers, medical tech, the list goes on. These aren't optional uses, they are absolutely essential.
And here's the crucial point. This demand is what economists call price inelastic. That means a company making solar panels can't just stop buying silver if the price doubles. They have multi-million-dollar contracts to fill. They have factories to run. They have absolutely no choice but to pay whatever it takes to get the metal they need, or they have to shut down production entirely. So that's the demand side. Now here's the supply side of the collision. You'd think, hey, prices are rising, so miners will just go dig up more silver, right?
Well, it is not that simple. Not at all. About 70% of all the silver that comes out of the ground is just a byproduct. It's found when miners are really looking for copper or lead or zinc. That means the amount of silver being mined is tied to the economics of other metals, not its own price.
And this right here, this might be the biggest piece of the puzzle. See, unlike gold, which is basically a monetary metal that gets hoarded and saved, silver gets used up. It gets consumed. It's put in tiny amounts into your phone, into a solar panel, and then it's basically gone forever. Think about it. Over 90% of all gold ever mined is still around and can be recycled. For silver, it's less than 20%. The vast majority of silver that's ever been pulled from the earth is now just gone.
Okay, so let's just recap. We have unstoppable demand crashing head-on into a supply that just can't budge. And on top of that, we have a paper market that seems to be totally disconnecting from physical reality. This brings us to our final section. What happens when a system under this much pressure finally snaps?
Well, history can give us a clue. For most of human history, all the way back to the Roman Empire, it took about 12 to 15 ounces of silver to buy 1 single ounce of gold. That was just the natural ratio, based on how much of each is in the Earth's crust. But today, that ratio is totally out of whack, sitting at around 50 to 1. This just shows how far silver has strayed from its historical value, and it suggests a huge correction could be coming.
So where is this all heading? Based on all these powerful forces at play, analyst Jim Rickards has a pretty stunning forecast. He sees gold potentially hitting $10,000 an ounce by the end of 2026.
And look, if gold makes a run like that, you can bet silver is coming along for the ride. And given all of its own unique supply and demand pressures, the forecast for silver is just as mind-boggling. It could potentially hit $200 an ounce in that same time frame.
So we're going to leave you with this one big question, a question that really gets to the heart of everything we've talked about today. For decades, we've all just accepted that the paper price on the screen was reality. But as the physical markets from Shanghai all the way to your local coin shop start to say something different, we have to ask, which price is real? The one on the screen or the one you actually have to pay to get the metal in your hand? The answer to that question might just redefine our markets for years to come.